Hello everyone, welcome to Oliveboard. In this session, we are going to discuss about the Financial Stability Report. So we all know that recently RBI has released the Financial Stability Report for June 2025. We'll be studying this particular report in a very detailed manner, right? Because this is very important for your examination. So this is part 1 of Financial Stability Report. Before starting the video, I would like to tell you about the RBI Grade B 2025 preparation kit. This is completely free. You will be getting 10 PDF ebooks, right? The RBI Complete Guide 100 plus Economic and Finance Terms, RBI Grade B PYQs as well for the last 5 years. Budget 2026 highlights and MCQs. RBI Grade B AIR one's notes is also included in this particular preparation kit, right? And a lot more things. So please download this particular kit. Do subscribe to it. The link is there in the description section. Okay, this will definitely help you acing the RBI Grade B 2025 examination. You can always download the Oliveboard app and you'll be getting all the notifications related to all the live sessions, and you'll be also getting the PDF notes of all the live sessions. So please download the Oliveboard application as well. We have launched the RBI Grade B 2025 complete course. This is for your phase 1 and phase 2. This is with books. You will be getting physical books as well in this particular course. You can check out the course highlights and you can enroll if you want to start your preparation with us. Let's start with Financial Stability Report. So we all know that Financial Stability Report is being published by RBI twice a year, right? So this is a half yearly publication. So this is nothing but a collective assessment of Financial Stability and Developmental Council, right? This is Financial Stability Developmental Council ka collective assessment on the current and emerging risk. So what are the current risk that is there in the economy as a whole, and what are the emerging risk? So all these things we'll be learning in the Financial Stability Report. We all know that one report already came, right, on December of the month of December 2024, and now we are having the Financial Stability Report of June 2025 as of now, right? So this will be very important from your examination perspective. You can also find the Financial Stability Report ka key highlights. Okay, so this particular document is also important. You can see here major pointers from the RBI Financial Stability Report, like elevated economic and trade policy uncertainties are testing the resilience of the global economy and financial system. Financial market remains volatile, especially the core government bonds market, right? Alongside the existing vulnerabilities such as soaring public debt level. We all know that public debt level is quite increased nowadays, not just for India but for all the countries, right? So here you can find all the keywords, all the core highlights from this report. Later on you can read these core highlights as well. First, let's cover Financial Stability Report in a very detailed manner. Okay, so if I talk about the FSR of June 2025 month, then in that case this report is divided into 3 chapters, right? So one by one we'll be covering each and every chapter. In the part 1 we'll be discussing about the micro financial risk, right? So the 3 parts are micro financial risk, chapter 1, chapter 2, financial institutions and what is the soundness of these financial institutions, how resilient they are, right? Chapter 3 is about regulatory initiatives in the financial sector. What are the regulatory initiatives in the financial sector? So broadly this report is divided into 3 chapters, and in today's video we are going to discuss about the first chapter, macro financial risk. Okay, macro financial risk. So this will be from the global perspective, not just from the domestic. It will be from a mix of the international plus the domestic perspective, right? Macro financial risk. So the good thing about these reports that RBI is publishing is they are always giving a blue box just after the name of the chapter. So the first chapter is macro financial risk, right? In this box we can see that they have written an uncertain and volatile global macroeconomic environment is there. Why? Because of the geopolitical tensions, because of the trade war, trade tariff, right? So uncertain and volatile global macroeconomic environment is testing the resilience of the global financial system as of now. The global financial stability risk have increased. Why? Because of the trade uncertainties, because of the geopolitical tensions, because of the existing vulnerabilities in the system, high public debt level, right? Amplify adverse shocks. So these are the basic things with which we are struggling globally. Okay, global market is struggling with these because of these reasons. However, if I talk about the Indian economy and the financial system of India, continue to grow, resilience, continue to exhibit resilience. So Indian economy is still showing resilience. It's still in good shape, right? Despite of having so many global uncertainty in the global environment, right? Aided by strong macroeconomic fundamental, we are having a strong macroeconomic fundamentals and a robust financial system, right? So broad I can get here keywords like there is uncertainty in the global market. However, despite of that uncertainty, everything is fine in India, right? So ये paragraph पढ़ने से you get a basic understanding of whatever things are going to be discussed in this particular report, right? This is a summary of the entire chapter, I can say, right? Broad keywords. Okay, so this chapter, ये काफी बड़ा chapter है. Chapter 1 is divided into many parts. Okay, so broadly we'll be discussing about the macro financial risk here. If I talk about macro financial risk, we'll be discussing about macroeconomic outlook, both global as well as domestic. We'll be discussing about financial market, global financial and domestic financial market, corporate and household sector, then banking system and NBFIs, non-banking financial intermediaries, and at the last we'll be discussing about the systemic risk survey, right? So these broad topics are covered under chapter 1. A very interesting report, financial stability report. It is loaded with a lot of data, with a lot of concepts as well. So at the same time we'll be discussing about data plus the concepts as well. Okay, so if I talk about the global macro economic risk, this screenshot is from the overview of the financial stability report. So majorly all the keywords are there in the overview itself. So you can see that what are the global macroeconomic risk? Elevated economic and trade policy uncertainties. There are trade policy uncertainties. There are some economic uncertainties. Multilateral agencies have downgraded the global growth forecast. So the global growth forecast has been downgraded by many agencies. Why? Because of trade disruptions, recent trade disruptions, because of volatility in the market, financial market, especially the core government and bond market. So in the financial market, the core government bond market is quite volatile nowadays, as per the financial stability report, right? So broad things, I can frame a map in my mind that yeah, these are the keywords that I need to understand. These are the keywords. We will be playing around these keywords only in this financial stability report, right? Soaring public debt levels. So we all know that public debt levels are quite high these days, especially in the United States. Excessive risk taking in the non-banking financial sector. So NBFI are taking excessive risk. How? Maybe they are giving unsecured loans. Maybe the problem of leverage is still persistent, right? So we'll be discussing each and everything in the particular report. Elevated asset valuation. Asset valuations are quite high. They are elevated. Emerging market economies are facing tensions because of escalating trade issues. Intensified geopolitical tensions. We all know that geopolitical tensions are the key contributor in most of the problems as of now. Then spillover from the advanced economy. So the problems of advanced economy again becomes problem for the developing nations as well. So these are the broad keywords I can read from the overview of the first chapter. Now let's jump to the first chapter. If I talk about domestic macroeconomic macro financial risk, Indian economy remains a key driver of global growth, right? So Indian economy here is a key driver of global growth, unpinned by the strong macroeconomic fundamentals and prudent macroeconomic policies. So we do have strong macroeconomic fundamentals and prudent macroeconomic policies. Because of that, we are still resilient. We are still driving our global growth despite of having slowdown in the global markets. The main driver is the strong domestic demand. We are having strong domestic demand now. We are such a big nation in terms of population, right? We have overtaken China as well. So because of the strong domestic demand, still our growth numbers are good. Moderating inflation, we are not having any kind of inflation issue as of now in the country. It's well within the control of RBI, right? It's well within the targeted range. Then healthy balance sheet of banks and non-banks and financial conditions. So we do have a healthy balance sheet both of banking sector as well as the corporate sector, right? There is a strength in the corporate balance sheet as well, plus low volatility in the financial markets, though FDIs are creating mess in the financial market because of the outflows. However, DIIs, domestic institutional investors inflow is quite increased these days. So we'll be definitely having a discussion related to the financial market as well, right? So let's start. Driven by high geopolitical tensions and economic and trade policy uncertainties. So we do have geopolitical tension as our problem. Economic and trade policy related uncertainties are there. Shifting US trade policies and lack of clarity. Still the US trade policies are not having lack of clarity, right? Still there is a clarity which is required. That's why there is a spike in volatility. Right? So basically the global economy faces a growth slowdown as of now. India is not facing that. However, the global economy is facing a growth slowdown, right? Financial markets have remained stable, but asset repricing risk is there if monetary policy tightens further, right? Plus advanced economies are witnessing moderate inflation, but it's still above the target level. However, for India, it's very well within the target level of RBI, right? So because of the geopolitical risk and economic policy uncertainty, we can see that economic policy uncertainty index is quite up, right? It's increased in the recent past, and geopolitical risk index is also up, right? So because of that, volatility is still there in the financial market, plus the GDP forecasts as well. If I talk about the domestic macroeconomic condition, then India is exhibiting a good macroeconomic, resilient macroeconomic fundamentals here, right? The headline inflation is again fine. If I talk about India, it's again fine. Current account deficit has also improved, right? So if I talk about India particularly, not in the global sense, the Indian economy continues to display resilience underpinned by these strong macroeconomic fundamentals. We are having a strong macroeconomic fundamentals plus robust financial system. The volatility in the domestic market has also remained low. So domestic market, financial market के अंदर volatility is still low as compared to the global countries, right? If I talk about the financial system stress indicator, overall the broader financial system remains resilient. The broader financial system is fine. However, there is some build-up stress. That's why we can still see this financial system stress indicator at an elevated level, right? There is some build-up stress primarily in the financial market. Why? Because of the global spillover. This is the reason, global spillover. So do remember this thing. Because of the global spillover, still our financial system stress indicator is at a elevated level as compared to the past data, right? So this has contributed to the slight rise, which is the marginal rise in the financial system stress indicator. This is an indicator which is indicating us the stress level in the Indian financial system. So if there is any kind of stress level in the Indian financial system, this index goes up, right? So it shows us the stress level in the Indian financial system as of now. If I talk about the growth inflation dynamics versus the historical average, we can see here that the global real GDP growth is below the average. This dotted line is nothing but the historical average, and we can see that the GDP growth is below the average as of now, right? If I talk about the global inflation, then it's quite within the range. I will say the expectation is that it will touch the historical average. If I talk about India, it's very well within the range abhi se. Okay. So escalation in the trade tensions and elevated policy uncertainty. The IMF in April 2025 World Economic Outlook has revised the global growth projection. So IMF has revised the growth projection, global growth projection, not of India. This is not of India. This is global growth projection, downward to 2.8% in 2025, right? So they have downgraded the growth projection to 2.8% in 2025 and 3% in 2026. This is the new projection, global growth projection by IMF. Okay. And they have a growth at risk model as well. It's an important metric to assess the risk to growth under the extreme scenario. So they do have a model as well. So as per their understanding, 2.8 will be the global growth rate for 2025 and 3% will be there for 2026. Okay, this is 2026. ठीक है, 2060 तो बहुत ही ज़्यादा हो गया. This is 2026. Okay. If I talk about the global growth projection, then in the global economy, it's for 2025, it's 2.8 as we discussed. For AE's advanced economy, it's 1.4, and for EMDE's it is 3.7 as of now. And we can talk about the private sector forecast as well for 25-26 as well, right? So this is the IMF forecast. You need to remember these figures. You need to remember these data, right? So please do remember the data. Now if I talk about the global inflation and monetary policy action of the major economies here, so we can see that this dot is nothing but the target. This dot is nothing but the target, right? And this is the current level as of now, right? So if I talk about India, we are already very well within the target. The inflation is this much and the target is overall above the actual inflation, right? So we have already around the target level only. We have already slashed our inflation quite very well. If I talk about other economies as well, South Africa is again fine, Indonesia, China, UK. If I talk about UK, inflation is still a problem, right? Inflation is still a problem. They are not able to bring their inflation below the target level, right? However, in Japan also there is a problem, right? US has also just achieved the target level of inflation, right? US has also achieved the target level of inflation. We have already reached very well below the inflation target. So I'm talking about the headline inflation as of now, right? And you can see the monetary policy action as well of emerging economies and advanced economies. Okay. If I talk about the public debt globally, right, for advanced economies, for emerging economies, so you can see that the public debt is going straight up, right? So globally, the public debt here is high. The public debt here is high, and it is creating a bubble. You can have a look at the USA debt level. You can have a look at the USA debt level. It's at crazy level, right? It's at all-time high as of now. If I talk about India, India का debt level भी is काफी high, right? So again, if I talk about the domestic outlook, then Indian economy supported by strong macroeconomic fundamentals remained the fastest growing economy. We are still the fastest growing economy, okay? Despite of the global uncertainties, despite of trade problems, despite of geopolitical tensions, still we are the fastest growing economy in the world during 24-25. Moreover, as India growth is largely dependent on the domestic demand. Why is it so that we are still the largest fastest growing economy? Because of the strong domestic demand, right? We are not affected by the global demand, but we do have a strong domestic demand. So RBI has again projected the real GDP to grow at 6.5%. Please remember this data. RBI projection of the real GDP is 6.5% for 2026, financial year 2026, which is the same which was also there in the financial year 2025. In financial year 2025 also it was 6.5, and for 2026 it is also 6.5, right? Because of the strong rural demand revival in the urban demand, right? So we do have a strong rural demand plus an urban demand with an uptick in the investment activity. So our investment activity is also up. We are investing in infrastructure, we are investing in the financial market as well, right? Plus the government has continued the capex and financial condition, right? So government is again boosting the capex, as I already told that there is a uptick in the investment activity, plus there is congenial financial condition. That means the financial conditions are apt as of now. Okay. The domestic inflation has been steadily declining. We all know that we have studying inflation regularly in the finance current affairs series, right? So it's steadily declining. I am talking about the consumer price index, CPI index. It is at a 6-year low of 2.8% in May 2025. So in May 2025, 2.8% was our CPI, right? So report is nothing, just a compilation of all the finance current affairs. If you'll compile all the finance current affairs related to the Indian economy and global market, it's nothing but a report, right? Report is nothing but a study of different scenarios which are there in the global market as well as the domestic market, right? So if you are having a good command on the finance current affairs and the entire economy related news, so definitely you can easily study the report. It will act as a revision for you guys, not a new thing. Okay. So the outlook of food inflation remains favorable. Again, food inflation also remains favorable. There are only two things that can create a mess: food inflation and fuel inflation, right? On account of softening the prices and robust crop production as well. Near term and medium term outlook gives greater confidence of durable alignment of headline inflation with a target of 4%. So we are already very well within the target. Okay, we have already achieved the suitability here. Okay, so CPI inflation combined, it's very well within the target at 2.8% as of now, right? If I talk about fuel and light, earlier it also went into deflation, right? This is the deflationary stage. This is the deflationary stage. Okay, the negative zone. So fuel and light inflation was once in the deflationary stage as well. Now it is recovered, right? Now it's moving up slowly, and food and beverages is again down. So basically your food and beverages is, because of your food and beverages index inflation, the overall inflation is also down. Okay. So if I talk about the global growth, okay, in terms of economic growth, then you can see that India is way ahead of the other economies, right? If I talk about China, if I talk about US, India is leading the pack as of now. And RBI projection of the GDP growth is as follows for the Indian economy, right? And if I talk about the India's financial fiscal position comparison, then for debt to GDP ratio, we are standing at 81.3. okay, we are standing here at 81.3. so debt to GDP ratio is nothing but how much our debt is as compared to our GDP. Okay, how much our debt is as compared to GDP. And interest expense to revenue ratio means how much interest expense we need to incur if you are earning 100 rupee of revenue, right? If you are earning 100 rupee of revenue, then out of that 24.3 we need to incur as a interest expense. Okay, so that's quite high. If I talk about interest expense to revenue ratio, this is quite high. Okay, debt to GDP ratio is also high. Then high gross foreign direct investment during 24-25 indicates that India continues to remain an attractive investment destination. We were having a very high gross FDI. If I talk about gross FDI during 2025 financial year 2025, then India continues to remain an attractive investment destination. Net FDI moderated. However, the net FDI moderated due to higher repatriation and the net outward FDI. So foreign portfolio investors again investment again moderated during 2025. And if I talk about external commercial borrowing, that is, we have borrowed from the international market, right? We have borrowed from the other countries. The external commercial borrowings and the non-resident deposits recorded higher inflows as compared to the previous financial year. So our ECBs and non-resident deposits are higher, right? Non-residents have deposited higher than the previous year. So that's a good sign, right? We are able to raise money. Foreign exchange reserves at US dollar for the June 20th June 2025 were $697.9 billion. That's huge. Are sufficient to cover again 11 months of merchandise imports. So if we want to see the coverage, for how many months this particular fund will cover, so it's covering us for 11 months. This will cover us for 11 months of merchandise imports, right, on the balance of payment basis. The external debt stood at moderate 19.1% of the GDP at the March 2025. The share of short-term debt on residential maturity again stood at 45.4% of foreign exchange reserves for the year ended March 2025. Okay, so here we can see that the India's foreign exchange reserves, so basically the curve is flat only as of now. There is a slight increase of 0.5 here from 11 to 11.5, right? I'm comparing with March 2025. So I'm comparing June 2025 with March 2025. There is a 0.5 increase as of now. Okay, I'm talking about the forex reserves, right? So forex reserves are increasing, plus import covers are also increasing, right? So this particular line is nothing but import cover, and these bars, orange bars, are foreign reserves, right? So foreign reserves are on an uptrend only. However, if I talk about import cover, then that's flat. So from the previous few months in the finance current affairs series also, we are discussing how much imports we can cover. So the answer is 11 months, right? So from March 2024 we are able to cover 11 months of exports as of now. It's slight on an uptrend as of now. There is a marginal increase of 0.5. Okay, 11.5 month. If I talk about the financial market globally, not of India, global financial market, unsettling of the global trade outlook following the announcement of tariffs by the US in April 2025. Now this has created a problem in the global financial market, right? As the US announced about the tariffs in April 2025, uncertainty came into picture. So uncertain economic outlook and corporate profitability led to a large sell-off across multiple market, and you can see in April 2025 month, majority of the big players, unke stocks has declined. Okay, whether it's about Meta, whether it's about Amazon or any other company, right? It was tough time, and it's still a tough time until and unless the trade policies are crystal clear as of now. Okay, so vulnerabilities in the global market, equity valuation risk. So the forward PE ratio means price divided by earning per share, right? So market price per share divided by earning per share. I have covered it many a times in my classes on YouTube. Let's suppose my market price is 100, but my earning per share, my per share value is 100. However, I am able to earn only 10 rupees out of it. So I can say that my PE ratio is 10 times. That means as compared to the earning per share, the price per share is 10 times more, right? 10 रुपए शेयर कमाता है, however the market price of the share is 100 rupees, so that 10 times. So again the equity valuation risk is there. Chance of valuation correction is also likely. Core government and bond data risk, bond market risk is also there. We'll be talking about this as well, right? What is core bond market risk? We'll be definitely discussing about that as well. Plus hedge fund activity. So what do hedge funds really do? They try to amplify your return, right? They try to increase your return. Now risk and return always go hand in hand. So when you try to increase the return, the risk also increases. How they increase your return? By taking higher amount of leverage. They do create a synthetic leverage. What is synthetic leverage? Now let's suppose if I am taking positions in the derivative market, I only have 5 lakh rupees. However, I can take positions of 20 lakhs, 25 lakhs. This is synthetic leverage. What is leverage? I have taken a loan, let's suppose at 6% per annum. I have taken a loan at 6% per annum, and I am enjoying the return of, let's suppose, 12% per annum. So that's a leverage. However, here I am not taking a loan. Here I am not at all taking a loan. This is a synthetic leverage. If I take positions in the derivative market, that's a synthetic leverage here, right? That's highly risky. It is high reward. It's having a very high reward. However, it is still highly risky as well, right? So hedge fund activity has created a synthetic leverage. Okay, that's also an issue in the financial market, global financial market. However, if I talk about the domestic financial market, then domestic financial conditions tightened during the January to March 2025. Why? Because of widening of the money and corporate bond market spread. Since April 2025, the financial conditions eased. Why? Because RBI has aggressively supported in the liquidity infusion, right? We all know that RBI has aggressively supported in the liquidity infusion. RBI has infused liquidity to a wider extent, I will say this time. Measures like policy rate cuts, both CRR and both repo rate cut. Because of that, a high amount of liquidity is there in the banking system, which is again supporting the domestic financial markets as well, right? The Reserve Bank of India injected durable liquidity amounting to 9.5 lakh crore via liquidity measures. So what is durable liquidity, guys? Can you guys tell me in the comment section what do you understand by durable liquidity? What is durable liquidity, guys? What do you understand by durable liquidity? A liquidity which will last for a longer period of time, right? There are two types of liquidity, durable and transient liquidity, temporary liquidity. So RBI has injected durable liquidity amounting to 9.5 lakh crore through various measures here, like open market operations, buy sell swap, right? These were long term buy sell swap. That's why they have contributed towards the durable liquidity. So if I talk about the India's financial condition index, so we have a India's financial condition index. Okay, so here you can see various things like government securities, equity, corporate bond, money market, etc. So somewhere here RBI has increased the liquidity, they have done the easing, right? So from there only financial conditions are better, so financial condition index is also better, right? So the domestic financial conditions have started increasing as soon as RBI has injected a good amount of liquidity in the system, right? If I talk about the liquidity operation, you can see a straight upward graph in the durable liquidity segment, right? This is durable liquidity. This yellow line is nothing but durable liquidity here, right? So the average durable liquidity is quite high in the month of April 2025. So additionally, the decision to cut the CRR, RBI was again taking multiple steps to inject durable liquidity, like open market operation, long-term buy-sell swaps, term variable repo rate agreements, right? A lot of things RBI has done. Along with that, they have slashed the CRR as well, cash reserve ratio requirement as well, by 100 basis point. So it will release liquidity of 2.5 lakh crore, right, of primary liquidity that starts from the September month till the December 2025 month. That definitely it's in 4 tranches of equally. So equal tranches of 100 BPS will be 0.25 BPS, 0.25 BPS 4 times. That sums up to become 100 BPS, right? So there is a infusion of durable liquidity in the market, right? So financial condition of domestic financial market overall, the financial conditions are accommodative only, it's good only. Money market is stable, short-term interest rates aligned with the repo rate, and corporate bond spreads are also stable. If I talk about government securities market, the yield curve is flattened here, right? So I'll be discussing about that as well. Equity market valuations are high. Okay, one can argue that the valuations are high. Whenever there is a high amount of liquidity in the market, definitely a part of that liquidity goes into the financial market, stock market as well, equity markets as well. Because of that, there is a high valuation ka problem, right? We'll be discussing about the mutual funds as well. So here we can see that the sovereign yield curve has bull steepened. That means has increased. 10th of June 2025 के डेटा के हिसाब से it has increased, right? It has increased. Why? Now, what is the term bull steepened meaning? What is the meaning of the term bull steepened? Look, the government bond yield curve has changed its shape, right? The government bond yield curve has changed its shape. Why? Because of bull steepened. Why? What is the meaning of this terminology? The short-term interest rate fell more than the long-term rates, right? So interest rate in the shorter period of time has fallen more than the long-term rates. Why? Because it happens when the investor expects a low inflation in the near future, right? So the short-term interest rates go down as compared to the long-term interest rates, because the short-term target of inflation is low, so expectation will also be low, right? And the interest rate in the near future. So this happens when the investors expect a lower inflation. If you expect a lower inflation, definitely your return inflation, your return expectation will also be low, right? So we can see here that driven by faster disinflation, because the inflation was going down, that's why it has resulted in increase in the short-term rates and monetary, because of the monetary policy easing as well. As I already told you that when a high amount of liquidity is there in the financial system, a part of that will go to the equity market as well, right? To the bond market as well. Okay, if I talk about the moment in USD INR rate, you can see that it's quite volatile in nature. Why? Because we all know that the USD INR pair got highly volatile because of the changing dynamics, right? So USD INR exchange rate recorded a sharp two-way movement during the January to May. Okay, so January to May के अंदर यहाँ पे काफी volatile moments हुए थे. We can see a two-way movement. What do you mean by two-way movement? This kind of movement. First, increase and decrease at the same time within a particular period, right? So that's called two-way movement. The pace of rupee depreciation accelerated in late 2024. So we all know that rupee started getting into that declining phase from late 2024, from December 2024 onwards, because of the liquidity problem, because of strengthening in the US dollar as well, right? We all know that. Then again, the pace of rupee depreciation accelerated in late 2024 and continued till February 2025. We can see that this phase was very much bad for the rupee. Sorry, this particular phase was quite bad for Indian rupee INR, right? In March and April month, however, it appreciated and supported, right? So we can see green candles here. So in March and April month, it got a support, and definitely it again start increasing. I'm talking about the INR, right? So this is the moment of USD INR as of now. If I talk about the real effective exchange rate, it's close to 100.8 as of now, April 2025 का data. It is nothing but REER. What is RWR, real effective exchange rate? It is nothing but an index. It measures that value of a country's currency as compared to the basket of other major currencies. So let's suppose if my RWR is exceeding 100, that means my currency is overvalued. If my RWR is less than 100, then it is undervalued. So we are somewhere near 100.8, above 100 only, since still we are below the average. So as of now, our currency is as of now undervalued. This is not at all overvalued. Though we are above 100, still if I compare it with the historical average, we are still good. Okay, we are still good. Now in this table, there is a resource mobilization through the Indian capital market. So you can later on check that how the resources are moving as compared to the previous financial year, right? Fund flow and NSE listed company ownership pattern. Also we can see that FPI and DII flow in the equity. Orange is DII, blue is the FPI. So we can see that FPI is almost negligible in April month, right? February, April month. However, in June 2025, it was negative, right? So FPIs, foreign portfolio investors, have withdrawn their money, and DIIs are quite supporting the economy as of now. They are quite supporting the financial markets as of now. And if I talk about the DII versus FII, then we can see that DII are already, they have invested more than the FPIs, right? Earlier, FPIs used to invest a lot of money in the Indian market, in the NSE listed companies. However, the story is opposite as of now. Okay. Then corporate bond outstanding turnover, you can have a look at the corporate bond outstanding turnover as well. Okay, we can compare it with category wise issuance as well, like who is issuing what, right? Here we can say that private placement banks are doing well, right? NBFCs are doing very well here. NBFC का सबसे ज़्यादा प्राइवेट प्लेसमेंट हो रहा है. पब्लिक इशू किसका सबसे ज़्यादा हो रहा है? NBFC का ही ज़्यादा हो रहा है. If I talk about corporate and household sector now, so Indian corporate sector remained resilient. It's again good. Indian corporate sector has again good, has done well, right? Because of the strengthening balance sheet, they are having a good balance sheet despite of moderation in the sales growth of listed private non-financial corporates. Their operating profits remain solid. Okay, despite of the moderation in sales, though the NFCs, what is NFCs? Non-financial corporates, unka sale moderate mein hai. However, the operating profit margin has still remained solid, and we can see here that the sales has moderately declined here. Still, the operating profit margin is constant, right? Is on the uptrend only. Okay, and we can also see that IT here is giving a lot of contribution as of now. IT sector is giving a lot of contribution as of now, then manufacturing, and then the non-IT service based sector. If I talk about the debt service ratio and cash buffer, here we can see the debt service ratio. The weighted average lending rates is at 9.3. The debt service coverage ratio of private non-financial sector is 11.3, which is below the average of 12.2, so close to 1%, 0.9% basically. The DSC is still down, right? Debt service coverage ratio, it's nothing but debt service ratio, like that means how well you are capable to, how well capability you are having to service your debt. Now in debt, two things are there: interest and principal obligation. So whether you are capable enough to settle your interest obligation as well as principal obligation, it's stating that only, right? So it's on the uptrend. However, we are still down from the average DSR as of now. And if I talk about the cash buffer of the listed private NFCs, then it's up. The cash buffer is very well maintained at 29.4% as of now. Debt to equity ratio is falling. It's lower than the earlier, whatever was there in the earlier financial year. So it's good again. Debt to equity ratio means nothing but debt divided by your shareholders fund, which is your equity, right? So I can say that you are using less of debt as of now, or you are using more of shareholders fund as of now. That's why the debt to equity ratio is coming down, and it's good. If it's coming down, then it's good, right? We can see here the corporate debt to GDP ratio as well as compared to other countries, and India is at the lowest as of now if I compare with China, Japan, right, and other economies. So still this is also positive. Debt to equity ratio is also positive. If I talk about the household sector, then India's household debt has been increasing in the recent years, driven by the rising borrowing from financial sector, right? So India's household debt has been increasing in the recent year because of the borrowing from the financial sector. As of now, we can see here an uptrend, right? If I talk about India, there is an uptrend in the household debt. So household debt is increasing basically. Then India's household debt at 41.9% of the GDP, which is quite huge, was relatively low as compared to the other EMEs. Still, it is relatively low as compared to the other emerging market economies as of now. Non-housing retail loans, which are mostly used for consumption purpose, formed 54.9% of the total household debt. So out of the total household debt, 54.9% is for consumption purpose only. Non-housing retail loan ही form हो जाता है 54.9%, and that's a big number. Housing loan on the other hand form only 29%. So housing loan is only 29%. This is housing loan, and this is for consumption purpose, right? 54.9% is for the consumption purpose, right? So now this shows that disaggregated data shows that the incremental growth has been mainly driven from the existing borrower. So this particular incremental growth is because of the existing borrower only. They have taken additional loan facility. They have taken additional loan facility here, right? So I've given you the charts as well. Okay, I've taken the charts as well from reports. It's always helpful to read the data from the chart in graphical format. We are able to remember the things and data more and more, right? So please refer to graphs only. That's my that's my personal request, right? It will definitely help you in it will definitely give you a long lasting memory. Okay, so growth of broad categories in the household borrowings, we can see that housing loans, they are up. Non-housing loans, they are increasing at a crazy pace. And again, the agriculture and business loan, they are also in a uptrend only. Okay, then the wealth of the households grew sharply in 23-24 since the COVID time. Since the 2020 COVID time, the asset prices gain contributed around 1/3 of the increase in the financial asset. So because of the increase in the asset prices only contributed directly 1/3 of the total increase in the financial assets as of now. So overall, the risk to the Indian financial system from lending to the household remain contained only with easing monetary policy cycle, because we are easing the monetary policy, we are cutting the interest rates as well. So again, it will be having a good impact. Why? Because the debt burden will be keep on reducing, right? The interest component of the debt will be reduced because of the reduction in the policy rates, right? So here we can see that after the COVID, contribution to the growth in the financial assets, if I talk about currency, if I talk about debt securities, equity and investment fund, you can see crazy volumes in the equity and fund investment, right? After the COVID. So if I talk about the composition of financial asset at the end of March 2024, then this deposits, earlier it used to be 46, now it's 40 only, right? If I talk about equity investments, then earlier it used to be 15 only, now it is 22. So a large part of deposit has now moved to equity and investment fund as well. Okay, debt again I can say is flat only. Earlier it used to be 0.8, now it is 0.6. And if I talk about the currency, again it's 1% down only, not at all a major fall. Insurance and pension funds, I can see this stable only. Again, there's a 0.2% increase, which is not at all a big one, right? So I can say that from deposits, people have start moving towards the equity and investment. So there is an increase in the equity and investment exposure as well, that contributed to the wealth building as well for the households, right? If we discuss the banking system, then scheduled commercial banks, strong capital and liquidity buffers were there. Again, asset quality was good, robust earning, they have posted robust earning, and adequate CET1 capital was also there, declining the loan losses and their credit cost and strong profitability and lending credibility was also there. So this is an amazing chart which is showing the performance of all the SCBs, scheduled commercial banks. So if I talk about gross advances, it's an uptrend, right? It's an uptrend. If I talk about gross NPAs, it's at the lowest level as of now. Net NPAs again at lowest level, right? Return on asset is quite amplified. So ROA is very good. ROA is nothing but return on assets, how much I'm able to earn by deploying more and more assets, right? CRAR is again at a good level, it's quite high. This is your capital adequacy ratio, or we can also call it as capital to risk asset ratio. Then we are having LCR, it's also standing at a good level as of now. Slippage is quite low. Slippage is again quite low. So all the performance indicators here are showing resilience. All the performance indicators are showing here a good result, right? If I talk about the SCBs. Now if I talk about CET ratio, it's up. SMA2 ratio, it's down. Credit cost down. Return on equity up. So overall the performance is very, very good. Overall the performance is very, very good here, right? Can you guys tell me what do you mean by SMA? We have studied this in the paid class. What do you mean by SMA? Asset shows a sign of stress, right? Before becoming an NPA, if an asset is showing a sign of a stress? Can you guys elaborate in the comment section? Do let me know. Now they could feel some of the pressure in the near term. Why? Because easing monetary policy, whenever there is a easing in the monetary policy, let's suppose RBI is reducing the rate, so the net interest margin is also shrinking, right? Credit growth has slowed, so we have seen that credit growth has been slowed. Economic slowdown can be possible because of the recent uncertainties, right? So that's again a problem. One more problem is bank liability profile is completely changing. Earlier banks used to heavily rely on the CASA deposits. However, as of now they are dependent on the higher cost term deposits and CDs, right? So when you raise money from CDs or term deposits, the cost is higher. When you raise money from CASA, then the cost is lower, right? So here it shows a policy shift as of now, because banks are now dependent more on CDs and TDs rather than the CASA. So post-pandemic, the bank loan growth was largely driven out of retail and service sector, particularly through the unsecured retail loans lending to the NBFCs. So banks were lending loans to NBFCs, and NBFCs are again doing unsecured lending. So definitely RBI, we all know that RBI has earlier increased the risk weight on the certain segment of the consumer credit and bank lending to the NBFCs, right? So RBI has increased the risk weights. If you are lending to NBFCs, then you need to face the problem of increased risk weight. That's again contributed to the decline in the NBFC lending. Right here we can see the profitability, credit growth and deposit profile as well. Now what is credit impulse? One word I can see here is credit impulse. One is credit growth. We can see a decrease in the credit growth as we discussed. There is a sharp decline in the credit impulse as well. So what is credit impulse? It is nothing but the change in the growth rate of new credit, whether you are able to give new credit or not in the economy, right? Now why new credit is important? It shows whether banks and financial institutions are accelerating or slowing down in terms of new credit. When new credit goes into economy, there is expansion of the economy, right? There is expansion of the economy. That means new players are coming in the economy. That will expand our GDP base. However, we can see a sharp decline in the credit impulse as well in this particular chart, right? Unsecured lending has moderated. It forms now 25% of the retail and 8.5% of the gross advances as of now. So I have highlighted all the important words from the report. You can even read these important things, right? It will help you cover majority of the things in a short amount of time, right? Then if I talk about the bank loan growth, the growth in bank loan to unsecured retail and NBFCs, now as compared to earlier, we can see here a slight decline in the red zone, right, from 11.6 to 8.8. And even if I talk about different sectors of the economy like agriculture, there is a decline. In industry, there's an increase. In service, there is a, it's constant only, right? If I talk about retail, again there is a decline. That's for unsecured lending. That's for unsecured lending, okay? Now if I talk about the GNP ratios coming from the unsecured retail loans, especially you can see that it's quite up for the private sector banks. The private sector bank share is increasing here. They are contributing higher as of now in the gross NPAs because of the unsecured retail loans here, right? The highest amount definitely is of, as of now, of the public sector banks. However, there's quite increase in the private sector banks GNPAs as well because of unsecured retail portion. And if I talk about share in GNPA, unsecured retail lending, then you can see that private sector banks are having the highest shares in the GNPA as of now in the unsecured retail lending. So this data you need to remember. The private sector banks are having the highest amount of share in the GNPA as of now if I talk about particularly unsecured retail loans, right? Now if I talk about write-off, okay, write-off continue to remain a key contributing factor to the NPA reduction. Now if we say that NPAs are reducing, how they are reducing? Either you are recovering the money or you are writing it off, right? If you are writing it off, then that's again a problem. Right? And we can see here that the write-off share is still quite high. You can see that red candle. This is depicting the write-offs. So it's still high. If I talk about the private sector banks, especially of the private sector banks, right? That too, it is emanating from the unsecured retail portfolio. So they are heavily writing off the NPAs. So NPAs are reducing. However, if they are due to write-off, then that's a problem, right? Then if I talk about the share of floating rate loans in the gross advances, that accounted for close to 79%. So it's good. If the loan is on floating rate basis, it will directly get impacted whenever we are doing the changes in monetary policies, right? So thus it works faster. It helps in the faster transmission of the monetary policy, right? Monetary policy will immediately inject money or suck money out of the system, because we are having majority of the loans on the floating rate basis, right? And you can later on see here as well, EBLR पे major loans यहाँ पे चल रहे हैं, right? And what is EBLR? You can later on download this PDF and have a quick reading as well. Now if we talk about the asset quality, it has shown improvement with the gross NPA of MSME portfolio falling from 4.5% in March 2024 to 3.6%. So earlier it was 4.5%. They have fallen down to 3.6%. Okay. So again, this is good. And if we talk about these two schemes, the NPA ratio of the credit extended under the select guarantee schemes has supported. So the government credit guarantee schemes improved the flow of credit to the MSMEs. So flow of credit to the MSMEs is quite improved. If I talk about the schemes like credit guarantee fund and fund for micro units and emergency credit line guarantee scheme, so these two schemes have contributed in improving the flow to the MSMEs as well. And even if we have a look at the banking stability indicator, the banking system has improved overall, right, on all the dimensions except profitability. Okay, so profitability dimension is still missing. Rest on all the dimensions it has increased. Now if we talk about the NBFIs, non-banking financial intermediaries, the sector has become important provider of financial intermediation, right? And the asset of the NBFIs have grown substantially. So it's now too big, right? If I talk about NBFIs, so ये काफी बड़ा हो चुका है यहाँ पे, according to the Financial Stability Board, of estimated $486.4 trillion global financial assets at the end of 2023. This is a share close to 49.1%. That's huge, right? It's almost growing at more than the double pace of banking sector. So there is a huge growth in the NBFI sector, right? However, this growth was due to excessive use of leverage. Global hedge funds have significantly increased their use of synthetic leverage. I already told you what is synthetic leverage. We can use synthetic leverage with the help of derivatives, right? I have mentioned here it as well, what is synthetic leverage. Okay. And here we can see that bank loans to NBFI as a share of gross loan and advances, right, has fallen. Why? Because RBI has introduced the risk weights criteria. They have increased the risk weights. We can see that bank loans to NBFI as a share of CET1 capital is again down, right? We have already discussed this thing. So now the NBFC sector remains healthy. Though NBFC sector is quite healthy, the growth is very good, right? Though it's emanating from majorly leverage, still the NBFC sector remains healthy with strong capital buffer and robust interest margins and earnings. The loan growth moderated. The loan growth is moderate, right? And regulatory measures to increase the risk weight on consumer credit उस वजह से भी moderate हो गई थी. Now the RBI has again restored that particular thing. So again the RBI has reduced the risk weights, right? We all know that. Now despite of increasing the risk weight, the banks definitely have reduced their exposure, right, in NBFC lending. Still, for NBFCs, bank finance still remained a dominant source of finance. We can see here that the bank borrowings are constituting 41.7%. They constitute 41.7%, followed by debenture holdings of 31.6%, right? if I talk about the mutual fund business, so mutual fund business is measured by the asset under management, AUM, right? Asset under management. So it continued to grow and reached a record high of 72.2 lakh crore. That's huge. In May 2025, right? SIP also was on the verge of slowdown, right? The SIP inflows were halted for a bit. It was in the trend of slowdown, right? It saw some slowdown in the recent month, both in terms of the net contribution and the terms of number of accounts, right? So the net contribution coming from SIP was halted for a bit as of now. Among different equity oriented scheme, if I talk about the different equity, if I talk about the different schemes, then equity oriented scheme and sectoral funds, the thematic funds, have attracted the highest inflows over the last year and a half, and we can have a look that the gross SIP contribution is as of now stagnant. If I talk about the net SIP contribution, then there is a fall in the net SIP contribution. What is the difference between gross and net? Gross means how much inflows are coming in the mutual funds, but if I talk about the net SIP, how much inflows are coming from the SIPs minus the outflows which are there, right? Now you are investing your money in the SIP, that means that's a gross inflow. However, sometimes you are withdrawing as well. So if you deduct from the gross inflows, if you deduct the net inflows, you will arrive at the, from the inflows of the SIP, if you deduct the outflows, then you will arrive at the net SIP contribution. So people have withdrawn their money as well from the mutual funds, from the SIPs, right? They have halted their SIPs as well. And the last thing in this chapter is systemic risk survey. So systemic risk survey, the latest round of RBI systemic risk survey, RBI is doing a SRS, right? It's nothing but a evaluation of systemic risk in the financial markets basically, right? Or in the financial sector as a whole. So conducted in May, all the major risk group remains in the medium risk category only. So all the major risk were in the medium risk category only. The global and institutional risk were perceived to have increased compared with the previous survey round as well, whereas the macroeconomic and financial market risk have registered a marginal decline as well. Okay, so this is about the systemic risk survey. Okay, and obviously the potential risk to the financial stability highest is emanating from the geopolitical conflicts as of now, right? Followed by the capital outflow, and obviously the capital outflow takes place whenever there is a geopolitical conflict. So somewhere or the other these things are related only. At last I am giving you some MCQs, so do let me know in the comment section what do you think should be the correct answer of these MCQs, right? The first one is, in the Financial Stability Report, the Financial System Stress Indicator FSSI showed a marginal rise in the half yearly in the second half of the 2025. So which of the following best explain this rise? So do let me know in the comment section what should be the correct choice. According to the FSR report of June 2025, what was the projected global growth rate for 2025 as per the IMF, International Monetary Fund? This is the second question. And the third question is, which of the following is not listed as a major factor contributing to the resilience of the Indian economy in the FSR June 2025? So these three questions you need to answer me in the comment section. I'll definitely be posting the correct answer in the comment section only. Okay guys, thank you so much. We'll be soon coming with the next chapters as well, next videos as well. So thank you so much for watching. Bye bye, take care.